Why do some companies want to go to IPO?
It's a good question, and it should be the first question that you ever ask a client who wants to do that. You can be surprised by the answers sometimes. IPO is not right for everybody for a number of reasons.
What makes one company more ready than the other?
Ultimately, as a private business, we will run that business as we want to. We own it. But as soon as you become public, you do have to behave differently. The investment community, people will buy and sell your stock. So you're going to be dealing with analysts that you never dealt with before and investors that you never dealt with before. Therefore, if you are acceptant of that at an early stage of the process, it's an easier transition for you.
He has built a remarkable career at PwC, where he was leading Middle East other assurance services. Today, he's a co-founder at Middle East Advisory Partners, which is a boutique firm.
Never stop learning. I take each client situation that I have and say, what can I learn from this? Put yourself into difficult positions.
If you were to start from IPO minus 100 days, how does the journey look like? You have to have financial advisors, due diligence, how the journey looks like. Hey everybody, welcome back to another episode of the CFO podcast. Today's episode is about IPOs, business turnaround, and value creation. And this is because our guest today has lived and led these journeys for more than 3 decades. He has built a remarkable career at PwC, where he was leading Middle East other assurance services, which includes many interesting domains, including the capital markets and accounting advisory. He was leading more than 20 partners, more than 450 very capable PwC resources with a very premier regional client base. Prior to that, he was a part of the PwC London office in the capital markets and accounting advisory team as well. Under his leadership, this particular practice at Middle East Other Assurance Services grew by 20% year on year. I also had the privilege of working in one of his teams in PwC Capital Markets Accounting Advisory team back in the day, where we worked on some very interesting assignments from IPO readiness to working capital reports, and that's when I really saw the impact of his leadership. Today, he's a co-founder at Middle East Advisory Partners, which is a boutique firm who's advising businesses around growth, turnaround, value creation, M&A, and much more. Without further ado, let me introduce you to my guest today, Steve Drake. Steve, thank you very much for making time for this podcast.
You're welcome. Thank you for inviting me.
Wonderful. Steve, so as I said, this podcast is going to be about sort of extracting value from the experiences that you've had over so many number of years. So Steve, I'm going to start with some things. This is what I generally do, where I start with the early life, some of the influences that you have. So would you like to share some stories around your early life, some of your early days influences, why finance, why PwC, etc.?
Yeah, so I grew up in the UK, in the northeast of England. Followed my football team, Newcastle United, still do. Decided to go to university in Newcastle. I did an economics degree. Quite liked economics, quite liked finance. Thought it would be an idea to get some kind of business qualification, so I went for chartered accountancy. So back now in 94, I joined Price Waterhouse as it was then. It was pre-merger with Coopers and Lybrand. Mm-hmm. Price Waterhouse in Newcastle. I trained to be a chartered accountant there, learned my trade, qualified in 97. And then continued to work with a firm. A little bit later, I moved to London, 99-2000, after doing quite a significant project in Riyadh. So my first taste of the Middle East was back in 1999. Wow. We were working with Saudi Telecom to help privatize the business. Mm-hmm. Obviously it is now, it's a listed company, but back then it was a government entity. So we did a 3-year project to privatize it. So that was my introduction to the region.
Mm-hmm. And that's where it led to your PwC Middle East stint from then onwards?
No, not quite. I went back to London, so I was still with the firm in the Newcastle practice. I joined the capital markets team in London in 2000, and we were a team that was focused on IPOs principally, either into the UK or the US. And I would work with pretty significant global clients who were looking at either of those jurisdictions. So I spent a lot of time working in Europe, in Asia. I spent 12 months in Japan, for example. I spent 12 months in South Africa and was generally always on a plane or a flight to somewhere. And then to kind of change that and get a little bit more balance back into family life, we had relatively young children back then. We moved to the Middle East in 2007.
Mm-hmm. Amazing. Steve, so having worked in so many different places and eventually getting, settled in one place, which is Middle East broadly, what made you stick with Middle East, and how different it is as a practice, as a working environment, as an ecosystem versus some of the other places, especially UK, where you've worked before?
So I suppose it coincided with time in my life where I wanted a little bit of change. So through to 2007, I'd been with the firm for 13 years then. I was about to go through the partnership process. I enjoyed being part of the London practice, but at the end of the day, it's a very big firm and everybody swims in their own lane. If you come out to an emerging market, you have much more latitude to do more things and experience more things. So I thought, why not? We came out on holiday in 2005 and 2006 to Dubai, saw what was happening, saw what was being built, and just thought I could probably make a difference here. So we took the plunge in 2007 to come and start a brand new business, zero revenue, zero clients, in a firm that at that point in time was still relatively small compared to what it is today. And therefore it was a real challenge to bring a new offering to a region that didn't understand it, had never bought it before, and yeah, those early days were interesting, but excellent learning curve, excellent learning experience. It also coincided with the financial crisis, so a difficult time to try to launch a new business in here, but it was fun. We enjoyed it.
No, absolutely, Steve, and it's nothing short of remarkable as to what you've built. So CMAS team you're the pioneer of CMAS team with some of your other colleagues, right? Back then, 2007 is when you started this practice, right?
That's right. There was two of us, myself and fellow partner Gavin Steele. He was currently working with the business in the Netherlands, but he'd had Middle East experience before and wanted to come back. So we kind of split our duties. He looked after the accounting advisory component of the business, and I looked after the listings and the IPO side of the business.
Yeah, I remember that.
But we started from 2, and when I left, I forget what the head count was, but we were close to 90-ish,
wow.
I think. Yeah,
and the business sprawling across Middle East. So no, that was a remarkable achievement, and I was lucky to be a part of that, although for a brief stint, but back in the day it was quite exciting. Okay, Steve. So, Steve, from here onwards, let's lead into our first theme, which is around the IPOs. So, Steve, again, I'm going to start with very fundamental kind of questions for the benefit of the audience, right? So, Steve, why do some companies want to go to IPO? Is it just the access to capital? Is it some shareholders want to exit? Is it just prestige, or is it a combination of all, something else?
It's a good question, and it should be the first question that you ever ask a client who wants to do that. Because you can be surprised by the answers sometimes. And there has to be a realization that IPO is not right for everybody for a number of reasons. If it's a question of raising capital, there are obviously more ways to do that. IPO is quite an expensive route to capital. Also, for companies that are in an earlier stage of their life cycle, it's perhaps a riskier form of capital raising for them. But at the end of the day, it is also generally an aspiration for companies. So they get to a stage in their life cycle where they've achieved so much with a business that actually is the right outcome and the right answer. So the reason you do it is multiple. You do it because there is a prestige factor, there is a capital raising factor, there is a maturity of the business factor, and there is also a factor that says, this gives us more credibility with our suppliers, our customers, our stakeholders. We've reached a level of maturity where we are a serious organization, and therefore it's right to be on a public exchange, of which there are many, many in the world.
There are many. You're right. And sometimes, Steve, what we see is that, as you rightly said, it's also sometimes government. I'm not saying government-led, but sometimes, for example, if you're operating in a banking sector where all of the rest of the banks are IPO'd and you're the only one who is not IPO'd back then, the government might encourage you to follow a particular path. So there could be a multitude of reasons, including the government government route as well, where they would want you to be listed as a company.
Yeah, absolutely. I mean, certain industries, financial services is a good one, and certain territories around the world would have a regulatory requirement that the entity is listed. And part of the reason for that is it provides strong governance. You have to meet certain governance criteria, certain governance rules, and therefore if you are a regulated entity that's listed, you're ultimately responsible for third parties' wealth or funds or money transfers or whatever it happens to be. So it provides that extra level of assurance for stakeholders. But also certain governments globally, and we've seen different waves of this throughout the last, say, 30 to 40 years, is privatization for government-related entities, to be able to take them from ultimately a government entity run by government officials to a private entity that is run for profit. Putting them on a public exchange is a good way to do that, because they generally are large entities to start with, very profitable, very sizable, typically quite global, and therefore the listing route is a good way to privatize them.
That's a very good example, and we are seeing quite a few of those in the region as well. Again, Aramco is one of those, and many others. So, Steve, let's play the story out. So, let's suppose now this company has found its reason to be IPO'd, whatever that may be, and then now they're working around IPO readiness, right? So, Steve, why is that certain companies just sail through their IPO process while others just stumble across through the process? What makes one company more ready than the others?
That's a good question, and I don't think there's one answer to that, but I would put it down to a large extent to culture, philosophy, and attitude. So what I mean by that is that there has to be a recognition with the owners of the business that they are about to go through a change process, and that once they've been through that change process, life will not be the same as it was when they were a private company, because they've sold part of their business, therefore they have other shareholders that they didn't have before. And they've also said we will hold ourselves to a standard that we didn't need to previously. Ultimately, as a private business, we will run that business as we want to. We own it. But as soon as you become public and you have external parties and external stakeholders, you do have to behave differently. That's not to say that you behaved badly as a private company, but you have to behave with the interests of these third parties in mind. And that's your shareholders, but it's also other stakeholders, your suppliers, your customers, your employees, the investment community. People will buy and sell your stock. So you're going to be dealing with analysts that you never dealt with before and investors that you never dealt with before. So therefore, if you are acceptant of that at an early stage of the process, it's an easier transition for you. And not all companies or clients understand that. And it's an awakening process for them as they go through that journey.
Interesting, Steve. You mentioned about all the reporting requirements that come along, because that was my next step into this conversation around that. Of course, IPO is a great milestone in any company's journey. Brings a lot of prestige as well. It's a proud feeling that capital markets have accepted you as a company, a legitimate business, and they hold a high, and now you're able to hold a high standard. But that comes with a lot of strings attached as well, right? Strings in the sense that you have to have those higher requirements on reporting, regulatory requirements, compliance, and all of that. You mentioned about analysts. So for companies who are aspiring to be IPO in the future, what are some of the strings attached, as I use the word, that they should be aware of, that they should at least know about?
So there are multiple, but as I've said, a lot of it is behavioral. So the starting point is that if the owners of the business are also in the business and they're critical to the business, the likelihood is that they will continue to be quite critical post-listing. Therefore, as I've said, their transition in terms of how they represent that company to their third parties is important. So helping them with that awakening process is key. And in doing that, it's helping them understand, well, what are some of those key changes going to be, and what are the requirements of the listing regime that you are entering into. They are broadly comparable globally, but they're not universal. There's not one universal set of standards by listing jurisdiction. But things like governance structures. So private company doesn't have to have a board. Public company does have to have a board. Most listing regimes will insist that that board has independent or non-executive directors. Well, who are they, and where do they come from? And they're not generally part of the board of a private company. So trying to establish what that board looks like and who you will bring in to supplement the existing team and the role that they will perform, and how you as the owners and board members will engage with them and embrace them and help them succeed. that takes time and effort. So a lot of whether it's governance or enhancing controls in the business or bringing in different people to the business, because you might be slightly different as a public company, you have different reporting, you have different obligations, you might need more people. Bringing them in advance and preparing for that process is quite key. And I always say to clients, it's get yourself into a position that you're actually a public company ahead of being one.
Yeah.
And you have these processes in place and you have people involved. Yes, there's a cost attached to it, there's a little bit of expense attached to it, but it makes that transition much easier if you do it in advance.
No, it does. Absolutely does. I mean, as you rightly pointed towards the code of corporate governance, I mean, it's broadly similar across different jurisdictions, but again, the reporting requirements, again, speaking specifically from a finance angle, I mean, you have to report in a certain number of days versus some certain number of weeks that you would otherwise report in a non-public context. So that's very important. Then you already mentioned about the analyst. I mean, you have to discuss your results with them. They would question, counter question, all of that, things that you wouldn't otherwise be used to doing. But I think you're right. It leads to a lot of cost increase. One thing that I've noticed in other companies is that company secretary is a thing where people otherwise would not have, unless they're a public listed company, would manage all of these affairs and stitch them together properly. So yes, a lot of cost and expense attached to this greater aspiration of an IPO. Steve, just to wrap this up around IPO, again, very broadly, if you were to start from IPO minus 100 days, how does the journey look like? You have to have financial advisors, your due diligence, your legal due diligence. What are some of the forces that have to come together in a chronological order? You don't have to be very specific, but just to give a broad idea to people as to how the journey looks like.
Yeah, there are a number of players in addition to the company. So it would be advisable to bring in an advisor to the owners who does nothing but work with them. They don't produce reports, they don't produce outputs, they just guide the organization. So that would be your IPO transaction advisor. In addition to that, you would have what you describe as your investment bank or your lead arranger. They have different names, but ultimately they're responsible for selling the IPO. So they will sell you with the exchange and support with the regulatory work that needs to be done. But most importantly, they will sell you to the investment community, and they will use their network in different territories to be able to do that, to place your shares. They will also work with you to determine, what are you worth, what's your valuation, how much should you raise, what should it be priced at, all those types of considerations. You then tend to have two legal counsel, external counsel. One will act for you as the company and look after your sole interests. The other will work for the investment bank to keep them legally clean and act in their interests. Generally two separate firms, but both working on the same transaction. You then have auditors, you have accountants, what's referred to as a reporting accountant, which supports a diligence process. That varies globally. But in simple terms, the bank that is selling you will want other parties to help them determine that you are fit and proper to be listed, and that's where the accountants play a role, the lawyers play a role also. You then have PR agencies who will help sell the IPO, place the IPO, make sure the messaging in the public is appropriate. And there are probably more that off the top of my head I can't remember, but there are multiple parties. Most of them come together when the IPO is launching, which I would say typically is a 3 to 6 month process. Ahead of that, the preparation stage, there are less parties needed or required for that. And I always advise put aside 6 to 9 months for that preparation process. So start to finish, IPO, yes, people can do it quicker, people have done it quicker, but have in mind it's something in the region of a 12 to 18 month process typically.
Wonderful. That's where us as accountants came into play back in the day when the bankers would appoint us to do a working capital piece or a due diligence piece and all of that. Steve, one last question just before I wrap this up around the IPOs. Steve, so while there's n number of things which are in the control of the company, is it also to do with the appetite of the government or the regulator to have certain amount of listings in a year or certain timing from a financial, how should I say it, from an economic standpoint? I mean, what I'm trying to say is, are there times when the governments are more open to listing companies versus the others, or is it just entirely in the hands of the company to make their process right and get listed? Is there something that the government has a role to play in as well, the regulator?
Not necessarily government. It depends on nature of jurisdiction. So in somewhere like the Middle East, where the government sector is significant, then yes, that has more of an impact than in, let's say, a much more developed stock exchange market like the US, for example, where there'll be limited impact from government. But you also have to take into consideration timing of you as a business and how you're trading and performing. Timing of the year. So generally people don't do IPOs in August because people are on holiday, right? Simple facts. And timing of liquidity in the market. So again, depending on the size of the market, but that's quite relevant in somewhere like the UAE, where there is only a limited amount of liquidity on the exchange. If there has been, or there will be, a significant IPO coming to market, and you're after that, then there may be limited appetite in your stock because there isn't liquidity on the market. So the timing is important, but it isn't just a government-related consideration. There are many considerations.
Sure. Wonderful. So I think this gives us a very good segue to move into the next theme, which is around business turnaround, Steve. So, Steve, while IPOs are exciting, a lot of prestige attached to that, but guess what? There are businesses in real world who are struggling with, slowing down of growth, rising cost, working capital issues, and all of the other things which they have to fix before they can even think about or dream of having an IPO. So, Steve, you do a lot of work where you help businesses turn around. So what are some of the things that you notice firsthand when you're invited by a founder or a business leader around their business? What are some of the things that you would want to know first to understand where the problem lies exactly?
Sure. So it's probably important to say that my focus now and our focus as a business is very much the owner-managed sector, or middle market, or SME, or you could call them all different things, but ultimately they aren't your listed companies and they're not your large corporates. They are the lady or the gentleman that have had an idea around a business and have developed it to whatever stage that is. So we work with the owner-managed sector. And generally speaking, we see a lot of positivity, a lot of good businesses, a lot of growing businesses, but they tend to have similar issues, whether they're performing well or they're not performing well. The issues tend to be similar. And we kind of characterize that as bandwidth. And what I mean by that is if you're in a large corporate, you have multiple departments, multiple people, multiple resources, multiple skill sets. When you put that into the owner-managed sector, there isn't the cash for that. They don't have that level of capability. So quite often when difficulties are hit, it's because there isn't that bandwidth in the business to be able to identify what the problems are. Yeah, they may not have a board of directors, so they may not have somebody to reach out to say, why are we encountering the problems that we have? So the starting point as to how do some companies get into difficulty, I would put around typically bandwidth, breadth of capability in the organization to be able to understand what's happening or foresee what's happening well enough in advance before it becomes a problem. What are some of those problems? Growth, yes, absolutely. A lot of businesses do very well to accelerate quickly, but then they get to a point where they plateau and they're not sure what to do next. Related to that is then financing growth, particularly in that sector. Bank lending, for example, is not easy to achieve, particularly if you're an asset-light business, and therefore being able to finance that growth and work through how to get to the next level. And I'd say perhaps just being cautious with cash flow. We see too many businesses that, with hindsight, or if they thought about it 12, 18 months before they did it, perhaps wouldn't have spent as much cash on some of the things that they did. So they actually run out of cash by not prioritizing it, or they get into cash difficulties by not prioritizing it.
Interesting, Steve, you mentioned about cash flow because as you and I were talking prior to this chat, I was at the LBS very recently and I happened to interview some like 10, 12 CFOs. And the most common theme that came out of all of them as their biggest financial headache right now was cash flow / working capital or something around that. Something which is very basic, it's the heartbeat of the business. It's not as fancy as AI and all of that, which means that while all of those aspirations around technological advancement, AI, automation are all there and we should follow them, but at the same time we shouldn't lose sight of some of the very fundamental things like the cash flow and the working capital. So continuing on that, Steve, So now, for example, you've identified the issue with a founder, with the owner of a business, that your working capital is too bloated. I mean, we need to sort of make it smaller, or cash needs to be better used. How do you balance this goal with not stifling the innovation spirit or the entrepreneurial spirit? Because again, there's a trade-off, right? So how does that balance go about?
It's often easier to spend money than receive money.
Yes.
Yeah. So how many businesses are not in that working capital cash trap? Most are. Yeah. And then, so obviously there are two elements to that. One is, how do you hang on to it longer?
Yeah.
And how can you push things as far as you can? And I think perhaps all too often our clients are scared to ask, or will find that their clients will not accept things or not be prepared to change their terms. So being brave enough to say, you know what, we actually need better terms than that, and these are the reasons why. Many entities don't like to do that. They feel uncomfortable doing that. So I think that's one part of it. The other part, as I said, is having a real grasp of the cost base and really challenging the cost base. Do you really need to spend that? Do you really need to hire that person? How can you use technology more effectively?
Yeah.
I don't see that adopted as well as it could be to reduce costs. I'm by no means a tech expert, but I increasingly use AI to support myself in everything that we do. Do companies do that? I don't think they do. I don't think they do as much as they could. Default tends to be people as opposed to technology quite often. So, look, there is no simple answer to this. I think for me, it's a critical review of line by line of everything that's in the P&L account to say, are we optimizing that as well as we can, or could we actually do something differently? And are we having the conversations with our customers, our suppliers, and really getting the best deals that we can out of those? And all our teams that engage with customers. So our sales teams really thinking about cash flow optimization when they're winning the next piece of work. Or are they more focused on winning the next piece of work, regardless of the terms that are attached to those? So that kind of interconnectivity between the business to make sure that everybody is singing off the same hymn sheet and aligned together for the best interest of the business. Not everybody does that.
Agree. And Steve, at certain point in time, I was working with a big distributor over here, and one of the biggest problems, again, in a distribution-based business is a massive working capital that is sitting on your balance sheet, as you rightly said, the cash trapped in working capital. And you're right, again, unless you start with questioning every line, and which is to say with sort of a zero-based budgeting, right? Because what happens in some of the family-owned businesses is that a lot of things become a usual BAU, business as usual. A lot of things would just carry forward. Oh, we did this last year, we should continue with this year as well, right?
Absolutely.
You don't tend to question it.
Challenge it.
Exactly. So I think that's very important. And then in addition to, as you rightly said, I mean, you speak to your suppliers, until you ask, you don't get it, right? There are other interesting things that we used to do back then, which is around factoring, reverse factoring, supply chain finance. There are a lot of other opportunities available to businesses to unlock cash out of their working capital. So speaking of working capital, again, Steve, I remember at a time you and I engaged on a particular discussion around this as well. How far do you see? I mean, again, it's a very generalized question, and you see a whole range of businesses across different industries, but how much do you see working capital, cash trapped in working capital as a problem versus other problems that are cost basis bloated, etc.? How far?
Most. Majority, absolutely. It's not very often you'll see businesses where cash in terms are better than cash out terms, in simple terms. And therefore your working capital position is exasperated. So the more that you grow, the more that becomes a problem. So again, it's working out as you grow and you get more credibility within your market. How do you utilize that to get better terms each time? Keep improving those terms, narrow that gap. You can have working capital facilities, but if you don't keep narrowing that gap, your facilities are always going to get larger and larger.
Indeed. So Steve, from here on, we talked about the IPO playbook. We talked about, before IPO playbook, there are certain problems in the businesses and how do businesses approach that. So that was theme 2 around business turnarounds. And the last theme that I would like to discuss with you, Steve, is around the value creation. So you told me that you help a lot of business businesses prepare for their exit. You work on a lot of sell-side mandate. How do you advise businesses on creating value before they are really up for sale? So as you mentioned already somewhere, that the value of your business is not when it's up for sale, it's rather created when it's not up for sale, it's before that. So just help unpack that a little bit.
Yeah, sure. I think it's a question of preparation again. So, if like anything else, if you were to sell your house or you were to sell your car, you don't want to sell a car that's dirty, yeah, because aesthetically people will look at it and they'll already reduce the value of it. So it's a similar concept with a business. How do you make it as clean and tidy and shiny as you possibly can before you do that? And that's what you call value creation. So, where are you in your life cycle? Why is now the right time to sell? Or actually, should you implement phase 1 or phase 2 of a strategy before you do? So is the timing right now, or is the timing right in 12 months or 24 months or whatever it happens to be? So looking at where you are in the stage of your life cycle. And then also looking at how clean you are. So again, quite often in private businesses, that there are a lot of costs that run through that either don't need to be there or actually aren't related to the business. So let's try and benchmark you on a normalized trend of what your cost base is, therefore what your EBITDA looks like. If let's say you're a client service business, if you've got 2 or 3 big bids in the pipeline that will materially change how your future forecast looks, then it would be premature to go to market and try to sell before you have those on board. Yeah. So again, looking at where you are, looking at where your revenue stream is, looking at how you are executing on the strategy for yourself, and determining therefore, well, how does that all fit together in terms of when I should sell, the value that creates. So if I'm worth X now, and I could be worth X plus 10% in 12 months' time, then maybe now isn't the right time to do that. But then there are also factors beyond your own house and your own cleanliness, and that is who's out there, who wants to buy. Am I in a sector that's attractive? And why it is attractive? Is it attractive to financial buyers, or is it attractive to my competitors? Would I be a good sale to a competitor in my field? Or in markets like this, we quite often say, how attractive are you to an international business that has no footprint here? And you'd be an excellent kind of platform for them to be able to develop their international business. And we've seen many transactions in different sectors. So understanding where you fit within your own marketplace, and therefore the timing considerations around your marketplace and who might be interested, are also key. So there are multiple things that come together to say, 1, should I sell? 2, when should I sell? And 3, what do I need to do within the business to maximize that sales effort for me as the seller?
Beautiful. Let's play this out further, Steve. So now, as a business who is building with the eventual target of exiting, so Steve, how do you see some of the sellers who are pretty much attached to a lot of vanity metrics, just top line, and they completely forget the other parts of their balance sheet or P&L? The whole focus is around just growing the top line, the customer base, the revenue, and all of that. I know most of the things are driven from that, but having too much emphasis on vanity metrics like revenue or top line would then just sort of just jeopardize some of the other important things like profits, like cash flows, right? And as they say, revenue is vanity, profit is sanity, and cash is reality kind of thing. So do you also advise them to look after their balance sheet as much as they look after their top line growth?
Yeah, no, absolutely. I mean, I suppose fundamentally in any sales transaction, there'll be a headline offer of X. But generally, the deal is done on what's called a debt-free, cash-free basis. So an owner needs to recognise that purchase price that has been put forward by the buyer is going to be adjusted by what sits on the balance sheet. So if you have lots of liabilities on your balance sheet, they will detract from your sales price. So again, if that's something that you can manage down through a preparation process so that your balance sheet is in much better shape, then you would do that. So that preparation element is not just about the P&L account, it is also looking at the balance sheet and what's in there. And if it needs to be cleaned up in advance, then yes, you absolutely need to do that.
Yeah, because it is a general tendency that I have noticed that owners, founders, managers of various businesses really do not place as much emphasis on their balance sheet as they do on P&L. I understand why, because the the flow of the business is measured through the P&L, but at the same time, balance sheet is equally important when it comes to the strength and the foundation of the business. So Steve, in your current capacity as the co-founder of Middle East Advisory Partners, I mean, what kind of services do you render to some of the businesses? Imagine if there's somebody who's listening to us right now, who's thinking about exiting or selling their business after some point. So what are some of the services that you can help them with?
Sure. So in very simple terms, our business, as I've said, is focused on the owner-manager. Our business model is about senior capability, so we only have partners in our business. Therefore, all of our clients get the time of the most senior people. We don't have junior staff. And we try to keep away from saying we do this, this, and this, because quite often our clients don't know what they need or don't necessarily know where their issues lie. So we try to find solutions to the problems that exist within particular clients. But as a result of that, the types of services that we tend to do would be around M&A activity. So that would fall into two principal categories: helping our clients sell their businesses and exit, either because they want to retire or they want to move on to the next thing, whatever their rationale is, or they want to scale it, and to finance that, they need to bring in a strategic partner. So sourcing a strategic partner who will buy a significant minority or significant majority, and then helping them with that process from trying to identify who the right partners are, giving them a strong sense of what they're worth, what their value range is, and therefore what that equates to in terms of a sell down, through to supporting them with the transaction through to financial close. That's a big part of our business. We'll also work on the buy side with typical diligence or identifying targets, those types of things for buyers. We do that for inbound in particular, overseas companies wanting to enter the Middle East. Don't know how to do that, don't necessarily know what a suitable target would be. And then what I might call transformational type work, so helping with scaling, helping pull business plans together, helping with better controls within the organization. And we also place some of our partners in as temporary C-suite to be able to run projects. So we've done that in the sales director role, we've done that in the chief operating officer role, and we've done that in the CFO role as well. So that would be interim or temporary arrangements where we would work to ultimately recruit and replace ourselves with a successor for the long term of the business.
Amazing. So a young business who doesn't have access to C-suite capabilities or doesn't have access to higher C-suite capabilities could use you and your firm and the partners that you carry on board to be able to get access to those expertise. So that's quite useful in that sense.
Yes, and it's only ever on an interim basis,
Cool.
Typically no more than 6 months.
Cool, amazing. So, Steve, I think that brings me to a close of the three themes that I wanted to cover with you today. Steve, as you know, this podcast is titled as the CFO podcast, and I usually do that for three kind of audiences. One is very young finance professionals who are, just joining into the firm, etc. The second is those middle managers who are looking on the other side of the senior side of affairs, where they're switching gears from fourth to the fifth gear. From middle management to more C-suite management. And then third, for the C-suite themselves, who are existing CFOs and who are, navigating through some of those challenges. So, Steve, you have worked with so many of these. I mean, you've worked with younger ones, as I was once. You've worked with the middle managers, you worked with the C-suite. Would you like to share some wisdom, some advice, some thoughts for each of those audience personas, if I may ask? It would be very helpful.
Yeah, I mean, I think never stop learning would be probably how I would phrase that. I put myself in that category. So I take each client situation that I have and say, what can I learn from this? What are likely to be some of the obstacles that I have seen before, or maybe I haven't seen before? Put yourself into difficult positions. So I remember when I was junior within the firm, I hated public speaking, hated it. So the only way to combat that was to do more and more and more of it until you became comfortable with it. So always put yourself into situations where you are going to learn, you're going to get a different experience. You don't fall into a comfort zone, or you don't fall into a role where it doesn't challenge you anymore. Always strive for that next role, that next piece of work that you think, I'm really going to learn from that, whether it's valuing a company or trying to identify a suitable target or doing a financial model that you've never done before. Whatever it is for the role that you're in, challenge yourself to learn. If you're the CFO and you know that growth is on the agenda, then organic, inorganic is going to be a consideration in that. So if it's inorganic, you drive it. You're the guy that's going to assess the deal. You're the guy that's going to ultimately identify the right target. So go for it. Go for the deal. Put yourself out of your comfort zone.
So true, Joel. And speaking about putting yourself out of the comfort zone, as they say, if you want omelets, you got to break some eggs, right? So that's what it is about. And speaking about continuous learning, Steve, you're a perfect example of that. I recently saw you completed one of the courses around M&A, mergers and acquisitions, valuations. Again, you're somebody who already knows all of this in detail, but then you would still want to refresh and continuing to polish your earlier expertise. It's a great example. Steve, perfect. That brings me to a close of our podcast. And just before I let you go, I have a this or that kind of rapid fire round. Sure. Where I ask a very brief question and I expect crisp responses.
Okay, I will try.
Yes, sure. So Steve, let's start with question 1. IPO or private equity exit? Which one builds more legacy and fewer gray hairs?
That's a tough one. They both do. IPO.
Okay. All right. So the second one is cost cuts or revenue growth. When the house is on fire, where should the CFO grab the hose first?
The CFO. I think the CFO needs to grab the cost.
Cost hose, yeah.
Let the CEO focus on the revenue.
That's correct. All right. Listing day spotlight or post IPO execution. Which moment truly makes or breaks a company's legacy?
It's definitely not the spotlight. It's how they perform as a public company.
Post-IPO, yeah, correct. Fixing broken businesses or preparing them for exit, which one gives more satisfaction? Turning the ship or docking it at the right port?
That's a good one. Both. Can I say both?
Yeah, you can.
Yeah, no, I think both.
Both.
Equally satisfying.
Okay, wonderful. And if I may ask why?
Because ultimately it's client satisfaction, and your client has satisfaction from both of those scenarios.
Actually, I think they're also sequential in order. First, you fix the ship, and then you dock it at the right port. Cool, Steve. Again, thank you so much for making time for this. I know you're traveling soon. I think I just got you in the right time. Thank you very much again, and I hope to speak to you soon.
Thank you. Thank you for inviting me.
All right, guys. Guys, this is the end of our today's episode. Steve Drake is a partner at Middle East Advisory Partners. He's quite active on LinkedIn. Feel free to reach out to him, and he would be more than happy to connect with you as well. Thank you. Until next time. Cheers.